Okay, quick question. You have a credit card, let's say you owe $10,000 on it. The interest rate is high, let's say 20%. And here's the thing, that card is a feature where the entire balance comes due at the end of the year. You have to pay it off and then immediately reborrow the same money at whatever interest rate the bank is charging that day. Now, imagine you can't pay it off. You can't lower the balance. All you can do is roll it over, take out a new loan to pay the old one, and hope the rate doesn't go up. That sounds like a nightmare's financial situation, right? That is exactly what the United States government is dealing with right now, except the number on the card isn't $10,000. It's $9.7 trillion and the clock is ticking. My name is Yeng and I cover the financial stories that most people don't hear about until they're already feeling the effects. If you want to understand what's actually happening with US debt and what it means for your savings, your crypto portfolio, and your financial decisions, hit subscribe and give this a thumbs up if this helps. Here's what we're going to unpack today. The US has $39 trillion in total debt. That number gets talked about constantly, but buried inside that headline is something far more urgent, and almost nobody is explaining it clearly. 33% of all US government debt, roughly $9.7 trillion, matures within the next 12 months. That means the Treasury has to go back to investors hat in hand and refinance nearly $10 trillion of old debts into new debt. At today's interest rates, in today's market environment. That's what this video is about, and by the end of it, you'll understand why it matters and what you can do about it. How debt maturity actually works. Let's start with the basics, because most people have never actually thought about how government debt works structurally. When the US government borrows money, it issues Treasury securities, bills, notes, and bonds. Each one has a maturity date. A 3-month Treasury bill matures in 90 days. A 10-year Treasury note matures in a decade. A 30-year bond matures in 30 years. Here's what most people don't realize. When a Treasury security matures, the government doesn't just pay it off and move on. It has to refinance it, meaning it issues new debt to pay back the old debt. It's a constant rolling cycle. And right now, an unusually large chunk of that cycle is all hitting at once. The Government Accountability Office, the independent auditor of the US government, published this report in March 2026. And on page 1, it states something that should have been front-page news everywhere. In fiscal year 2026, Treasury will need to refinance $9.7 trillion of maturing securities. $9.7 trillion in one fiscal year, that's roughly the size of the entire Japanese economy, coming due for refinancing all at once. And when you stack this on top of the $9.2 trillion that mature in 2025, according to Deloitte's analysis, the US has essentially had to refinance roughly half of its entire debt load in just 2 consecutive years. So why this moment is different? Here's the thing. Refinancing debt is not automatically a crisis. Governments do it constantly. The question is always the same. What rate do you have to pay when you roll it over? And that's exactly where 2026 gets complicated. Look at this chart. In 2020 and 2021, interest rates were near zero. The US government was able to borrow at some of the cheapest rates in modern history. Trillions of dollars of debt were issued at 0.5%, 1%, and sometimes less. Now fast forward to today. Today's 3-month Treasury bill yields around 3.85%. The 10-year note is yielding around 4.43% to 4.51%. So here's the math that matters. Imagine $1 trillion of old debt was issued at 1% interest. Annual interest costs $10 billion. Now that debt matures and gets refinanced at 4.3%. The new annual interest cost is $43 billion. That's a $33 billion per year increase from refinancing a single $1 trillion. Multiply that across $9.7 trillion, even partially, and you understand why the Congressional Budget Office projects the annual interest costs crossing $1 trillion for 2026. The government didn't spend more, it didn't add new programs. the price of the existing debts just went up automatically because the old cheap debt expired and had to be replaced with expensive new debt. This is called refinancing risk, and it's happening at a scale and speed that is genuinely unprecedented in modern US financial history. What the Treasury Secretary actually said. Here's where it gets really interesting because the person running US debt management essentially admitted the problem publicly. Treasury Secretary Scott Bessent last year said this about long-term debt issuance. Why would we do it? We are more than one standard deviation above the long-term rates. The time to do that would have been in 2021, 2022. What he was saying is the window to lock in cheap, long-term debt when rates were near zero has already passed. The government missed it, and now the Treasury is stuck issuing short-term debt, bills that mature in 3 to 12 months and rolling it over continuously at whatever rates the market demands. Think about what that means structurally. Every 3 months, every 6 months, every 12 months, the Treasury goes back to market. And every time it does, it's exposed to whatever rate environment exists at that moment. If rates stay high or go higher, every single rollover costs more than the last one. The interest burden compounds automatically without Congress voting on a single new dollar of spending. Where this is the mechanism. This is why the debt isn't just a political talking point. It's a structural financial system that is now feeding on itself. And what this means for your money. Let's get to the part that affects you personally because this isn't just an abstract government accounting problem. Here are the effects. Your mortgage rate is connected to this. When the Treasury floods the market with trillions of dollars of new debt, 10-year notes and 30-year bonds, it competes with every other borrower for the same pool of capital. More Treasury supply means investors demand higher yields to buy it. Higher Treasury yields pull mortgage rates up with them. The 10-year Treasury note yield and the 30-year fixed mortgage rate move in the same direction almost always. Right now, with the Treasury needing to refinance $9.7 trillion, the supply pressure on bond markets is relentless. Number 2, your savings rate is a downstream product of this. High-yield savings accounts paying 4.15% sounds like great news, and in isolation it is. But that rate exists because the Treasury is paying 4.15% on short-term bills, and banks have to compete with that rate to keep your deposits. If Treasury rates ever fall, your savings account yield falls with it. The two are linked. Number 3, Bitcoin and crypto markets feel this pressure too. Here's what most people don't connect. When the US Treasury is offering 4.15% guaranteed returns on short-term bills, institutional investors have a real alternative to holding risk assets like Bitcoin. The higher and longer Treasury yields stay elevated, the more competition Bitcoin and crypto face for institutional capital. This is why the debt refinancing story and the crypto market story are the same story told from different angles. Number 4, the dollar itself is under slow pressure. According to Deloitte's analysis, the dollar has declined 6.9% against the yen and 12.7% against the euro since January 2026. Part of this is tariff uncertainty, but part of it is the structural signal. When foreign investors see the US refinancing $9.7 trillion of debt at elevated rates, confidence in the dollar as a long-term store of value quietly erodes. That erosion shows up not just in currency markets, it shows up in gold prices, in Bitcoin's long-term narrative, and in the purchasing power of every dollar in your bank account. Here are 3 things you can do about this right now. Look, I'm not here to tell you the sky is falling, but I'm here to make sure you're not the last person to understand what's happening. Here are 3 practical moves that make sense in this environment. Number 1, lock in short-term Treasury rates now. 3-month and 6-month Treasury bills are paying around 3.85% to 4.51% right now. That's the government's guaranteed yield with zero credit risk. If the debt situation forces the Fed to eventually cut rates, these yields will fall. Locking in a 6-month or 12-month bill captures the current rate before any policy shift. Number 2, understand your mortgage exposure. If you have an adjustable rate mortgage or a HELOC, your rate moves with market rates. In an environment where Treasury supply pressure is keeping long-term yields elevated, that exposure matters more than it did when rates were at zero. Number 3, treat Bitcoin's long-term thesis as macro, not speculation. The refinancing cycle we are describing, $9.7 trillion rolling over at higher rates, projected at $1.9 trillion per year, dollar confidence quietly slipping. This is the exact macro environment that Bitcoin's digital gold thesis was designed for, not for trading, but for holding as a hedge against the long-term debasement of a currency that its own Treasury Secretary admits is trapped in a short-term debt cycle. Here's the honest summary. The US has $39.28 trillion in total debt. 33% of it, nearly $9.7 trillion, matures within 12 months. That debt must be refinanced at today's interest rates of 4% to 4.5%, up from near zero when much of it was originally issued. The result is an automatic compounding increase in interest costs that the Congressional Budget Office projects will cross $1 trillion for 2026. And the person responsible for managing this just admitted publicly that the window to fix it the right way has already closed. This is not a future problem, it's a present one, and its effects are already showing up in your mortgage rate, your savings account yield, the dollar's purchasing power, and the pressure on every risky asset you hold. The investors who understand this environment clearly will make different decisions than the ones who don't, and that difference over the next 3 to 5 years will be measured in tens of thousands of dollars. You understand it now? If this video gave you a clearer picture of something genuinely important, please hit the like button. It helps more people find this content. Subscribe and hit the bell. I post every week on crypto, investing, and personal finance. The debt refinancing story is not going away. I'll be covering every major development as it happens. Drop a comment below. Did you know 33% of US debt was maturing this year before watching this video? And what does that change about how you're thinking about your money? I read every single comment. See you in the next one. Bye!